I'm April, here with your tax fact. So today we're going to talk about IRAs. The decision to contribute to a traditional IRA versus a Roth IRA has to do with two major factors. First, do you qualify to contribute and deduct either the traditional or the Roth IRA? Both are based on income. And second, when do you want to pay the tax? So let's deal with the technical part, the differences between the two IRAs, and the income limitations. Then we'll discuss the philosophical discussion of the tax. Here are the basics. So the maximum you can contribute to either IRA, the Roth or the traditional, is $5,500 if you're under 50 years old and $6,500 if you're over 50, but no more than your earned income for the year. If you make, say, in the calendar year, $3,500 in wages, then you can only contribute $3,500 to an IRA. Also, you can contribute $5,500 to all one type of IRA, or you can allocate in any percentage between the two, as long as you don't go over $5,500. Now, the Roth IRA is not deductible in the current year, so you're going to be paying tax on it now, but when you pull the money out, the earnings will be tax-free. So in the future, that's no tax due on the earnings, unless of course they change the law, in which case they'll probably grandfather you in. So you may not be able to contribute to a Roth if your income goes over $114,000 for single or $181,000 if you're married. But there's no limits on the income to convert your traditional IRA to a Roth IRA. We'll talk about this more later. A traditional IRA is where you can deduct the contribution from your current income and reduce today's taxes, as long as you're not covered by a pension plan at work. So you can check your W-2 and see if a retirement box is checked. If you're covered by a pension plan, then you'll have to look at your total income. If it's under $61,000 for single or under $98,000 for married filing joint, you'll be able to defer the tax. If you're over the $71,000 or $118,000, then you won't get any deduction. But if you're in between, they'll allow some percentage of it. But you can still make the contribution. You'll just need to fill out a Form 8606 and file the return each year showing that you made a contribution, that at some future date when you go to withdraw the funds, you don't have to pay the tax on it then because you've already paid the tax. So it's kind of not very cool way to do it, but a lot of people will do it. So now, for the philosophy, the theory of most tax professionals is to postpone taxes as long as possible, assuming sometimes that your tax rate in the future is going to be lower when you're retired. However, there's a much more likely chance that the tax rates are going to be higher in the future, but this is all kind of crystal ball stuff. We really don't know. So you're making a decision based on the best information we have at the time. So with the Roth IRA, you pay the tax now on a smaller savings contribution, and the theory is that you're going to protect your savings on a larger, higher tax later on. Whereas with the traditional IRA, you're going to pay tax on everything you withdraw when you go to retire. And it's going to ding you for a much bigger tax because the theory is that when you make this money in the future, it's going to grow to a much bigger pot. So to hedge your bets, I recommend that you do a little bit of both. And I would put the lion's share of the contribution into the Roth. There will always be a certain amount of money that the IRS allows you to make tax-free. So why not just pull the money out of your traditional IRA to cover that tax-free amount, and then anything you need to live after that, you take from your Roth to help supplement your income. So that way, you kind of hedge your bets and you take from both. So that way you might get tax-free money from your traditional now and in the future. So there you have it, the differences between the traditional IRA and the Roth IRA. I would recommend that you talk to a tax professional because gets a little complicated, and make sure that you set up the appropriate mix and strategy unique to you. This is April. This has been your Friendly Tax Fact, brought to you by Ambrozy Accounting.